Dividend investing is a very popular strategy that many people are interested in. Throughout this video, I'll be showing you the pros and cons of this investing strategy, what to actually look for when selecting a dividend yielding company, and the exact steps that you need to take to actually purchase shares of a dividend business using a broker. First of all, jumping into the pros of dividend investing, it's a truly passive source of income. You don't have to do anything. You wake up in the morning and there's money deposited in your bank account from those consistent dividend yields that you are gaining from the investments that you've made. It's an excellent way to earn compound interest, and this is essentially the interest that you earn on your interest. The best strategy with this is to reinvest those dividends so you can keep making additional money from it. Taking a look at this chart, you can see the exponential growth that a portfolio can have if the dividends are continually put back into it and not taken away and spent on other things. Over time, the jumps in the portfolio gain more and more traction and become bigger and bigger, and it has a strong snowballing effect that can see a huge return on your investment. It protects against inflation as well. Year by year, you always lose between 1 and 3% of the buying power of your money, and dividend investing cancels out a percentage of that. Many yields are greater than 3%, so you'll actually be gaining money as opposed to losing it. Many dividend companies are also ETFs, making it a very consistent and reliable investment because your money is spread out amongst multiple different businesses and you're not at the mercy of a specific sector or one company. This will provide a more consistent return and reduce the overall volatility of your portfolio. The cons of dividend investing is that you don't make money very quickly. The gains are much slower in comparison to growth stocks like Tesla or other investment options such as cryptocurrency. These can see hundreds of percentage increases in just 1 to 2 years, and the slower growth rate of dividend investing is related to the fact that the majority of companies are blue chip or well-established businesses that have seen the majority of their growth already and are just seeing a slow percentage increase in their capital value. Dividends are paid back to investors from a company's profits, and a company must be making a lot of money and be quite established to actually afford paying out this dividend. Growth businesses that borrow a lot of money and have a far greater return on investment don't really want to be paying out part of their profits in the form of a dividend. They'd rather reinvest that money in order to grow the business. Dividend yielding companies include businesses such as Apple, Coca-Cola, and McDonald's. These are valued in the hundreds of billions or even trillions of dollars with a very high market cap, and they don't really have that much growth potential anymore. Dividends can also get cut. Taking a look at Disney, which in 2020 cut its dividend due to the COVID pandemic, and it had been paying out its dividend amount for over 40 years, and it was a very well established and profitable business, but dividends aren't guaranteed and they can be reduced or cut at any time based on the financial performance of the company that's paying them out. Now that you're familiar with the pros and cons of dividend investing, how do you actually go about purchasing some dividend stocks for yourself? Firstly, you're going to need a brokerage platform. As you can see on screen, there's different brokers based on which country you're in. If you're in America, there's Robinhood. England, there's Webull. In Australia, you can also use Stake, and in New Zealand, there's Hatch and Sharesies. So for this example, I'll be using the brokerage platform Stake because it has the most international support out of the brokers that I have access to, as I'm currently living in New Zealand. So the process for this will be virtually the same regardless of which broker you are using, so you can follow along no matter where you are in the world. So I'll just give you a quick run through of setting up an account. You'll need some ID, either driver's license or passport, proof of address. You'll have to fill in your email address, phone number, and your name as well. Pretty much the same as just making a Facebook or Instagram profile. All of that information gets verified, and then you'll be ready with a brokerage account. So when you're setting up your account, you can also put in a referral link to get a sign up bonus. So with Stake, you'll get a free share in either GoPro, Dropbox, or Nike, and currently the Nike stock is valued at $130 US, and with Hatch you'll get $20 when you first sign up as well. So make sure to pop those in if you want to get some free money when first making your account. But once you have all of your personal information verified, this is what the home screen will look like. Say for example, I wanted to buy some shares in Apple for my dividend yielding company. I'll just go up to the search bar here, type in Apple, and then hit enter. As you can see, Apple pops up here, and there's a lot of financial information about the business, like the average return over different time points, say 1 month, 6 6-month or 1 year. You can even look at a candlestick graph and the highs and lows for that business and some numerical information like the PE ratio and market cap. So once you found the stock that you're wanting to invest into, click on buy, and then it will give you a few different options. So I always go with market order, which is just buying the shares at the current market price. Put in the amount that you're wanting to invest or the number of shares that you're wanting to purchase, and then hit enter. You'll be good to go, and then the shares will be deposited in your account either instantly or within 24 hours, depending on which broker you are currently using. If you want a bit more context on setting up your account, I'll leave a video linked on screen where I gave a tutorial on using the platform stake, so make sure to check that out if you are interested. So that's how easy it is to invest your money and actually buy shares of a dividend yielding company. But how do you actually figure out which companies you should be investing in to get the best results? Some key things to look out for is how long has the dividend been paid out, and has it been consistently increasing? A great place to find out this information is on Yahoo Finance. Just search in the company that you're wanting to look at. For example, I'll use Coca-Cola, and then go over to historical data, and then in the middle here click the drop down box, hit dividends only, and then you can select the spread of time you're wanting to look at. So you can clearly see here with Coke that the dividend has consistently been paid out easily for the past 10 years and has been increasing over time. Another thing to look at is how well has the stock been performing. You don't want to be caught in a dividend trap, and that's when unsavvy investors are lured into purchasing or investing into a company just because of the high dividend yield despite the stock price consistently falling. Taking a look at something like AT&T, which has a dividend yield of 8.7%, the value of it has dropped by 42%, meaning that if you had invested $10,000, your portfolio would only be worth $5,800. You would have actually lost $4,200 if you had bought into this despite that consistent dividend payout of almost 9%. In comparison to something like Coca-Cola, which only has a dividend yield of 2.86%, but it has been steadily increasing in value by 45% over the past 4 years, meaning that if you had invested in Coke 5 years ago, your portfolio would actually be worth $14,500. With ETFs, there's a risk versus reward in terms of how high the dividend payout is and what the capital appreciation is. Remember, the higher the dividend, the less money the company has to reinvest into itself to grow. It also can be a negative factor, and the dividend payout is not the be-all end-all statistic that you're looking at when you're trying to research a company. Also keeping in mind that there's stocks that pay out dividends and ETFs as well. If you're going with ETFs, which is just an investment product that has a particular goal, you can get ones that might track the top 100 highest dividend paying companies in the US stock market. Make sure that the ETF is comprised of at least 100 companies made up of multiple different sectors so that you are not at the mercy of the market. If one sector is doing poorly, then there will be others in that ETF to balance it out, and this will give you a nice consistent return over time. Also, when looking at individual businesses, make sure that it does have a nice high market cap, ideally over $150 billion, because these will make it more of a blue chip, well-established business that actually has the funds to pay out a consistent dividend. If you're looking at something like Coca-Cola, its market cap is $266 billion, meaning that it has a lot of capital value to actually maintain that dividend payout. And also look at the long-term strength of the company. Will it be around in 10 years time? I feel like a business such as Coca-Cola or Visa, which do pay out dividends, will be around in the future. People always need a way to spend with a credit or debit card, and it has mass adoption. Visa is very much adopted in society, and Coca-Cola is also a brand staple that has clear recognition, and it has been around for decades. So you can safely bet that these companies will be around for decades in the future and will be able to pay out that dividend to its investors. So those are some of my favorite individual businesses to invest in for dividends. But what about ETFs? As I said earlier, these can be far superior because they give you targeted exposure to multiple different companies, meaning that you have a better average return and a more consistent dividend payout. They are a powerful investing tool when it comes to building a profitable dividend yielding portfolio. Just taking a look at something like KWD, which is the Invesco KBW High Dividend Yield Financial ETF. So this ETF invests in some of the highest dividend yielding companies that are based in the financial sector. Over the past 10 years, it's had had an average return of 8.58%, meaning that if you had invested $10,000 10 years ago, your portfolio would be worth $22,800. And on top of that, its average dividend return is 6.77%. So you can see the balance between capital appreciation and dividend payout with a well-balanced ETF, because the goal of the ETF is to invest in the highest dividend yielding companies in the financial sector, so it can far outperform an individual business in terms of providing a good dividend payout. If you want some more recommendations on my favorite ETFs like this one, then check out this video on screen where I show you the best ETFs that pay out a monthly dividend. If you've made it this far into the video and find the content helpful, make sure to drop a like for the YouTube algorithm, and I'll see you in the next one.